Thank you, everybody, for joining. I'm going to hand it off to Jason to start our weekly Q&A with our members. Thank you.
Okay, so I got my friend Bob is going to come on. He's an old friend of mine that's been involved in institutional fixed income market for probably the better part of 30 years. And he knows a lot about the Fed and what they're doing because him and his buddies actually sit there and like read all the text of the whole thing and then sit around and talk about it. And so he's going to get on here in a couple minutes and hopefully be able to answer or talk about how they're seeing the whole Fed macro interest rate shenanigans, because it confuses the shit out of me. So I'm just trying to stick with the COT stuff. And I don't know, anybody have any questions on the COT stuff? It was pretty self-explanatory. I think it's interesting that they're starting to get some, we've been seeing for months, obviously not a lot of crowdedness. And now all of a sudden we're getting some shit that's starting to get pretty crowded. And except they're not all going together. They're going like against each other in terms of like things that are usually correlated, right? It's great when you can get all correlated things to be super crowded one way, because then shit, all you need is like one or two of them and you can crush it, right? And God forbid you get like five of them or something stupid like that, then you kill it. But it also, I always feel like it helps if all the stuff that is correlated is all one-sided. I think it increases the odds of things turning. But having said that, that's not what we have right now. We have a bunch of crowded shit, but it's like all crowded against the correlations, which can also be very interesting because correlations don't always hold clearly. And even when they do, you look back 6 months and say there's a 6-month correlation there, but that doesn't mean every week or that it did stuff. So sometimes that can offer really good opportunities from a pairs trade type of thing because of that. Sometimes they end up both working, which is obviously a home run. But even when that doesn't happen, there's a good chance that if you're on the crowded long one that they're all short and short the one they're all long, there's a good chance that even if the correlation holds and it goes up, the one goes against you, the one that goes for you goes for you a lot more, which can be fun too. So that's kind of where I'm seeing some of this COT stuff. I don't know if anybody else was seeing anything that they thought, or if they had any questions about any of that.
Yeah, question, Jason, about equities. And based on your commentary and the thought that for the market to continue higher, ideally it'd be led by the NASDAQ, but the NASDAQ right now is showing as a short setup. So thoughts on that. And then just FYI, Bob did join. He's on video as well.
Oh, good. Bob, give me 1 second, right? Can you hear me, Bobby? Anyway, the first question is the NASDAQ set up? It's set up on the index level, 100%. It is. I'm still of the biased view that it's set up on the index level because we came from such ridiculously short levels that on a relative basis, yes, the index level is going to show that. But they're clearly not mega long, right? So, and that means that, if the market's going to go up, there's nothing really, if they're going to get mega long NASDAQ at some point, and we're going to go from here to the mega long NASDAQ, there's no reason that NASDAQ can't lead the market up, if it's doing that. The COT doesn't tell you exactly all the time, like, hey, this one's a little bit, this one's more crowded than this one, so therefore, look at where the Dow is. They're essentially neutral now, Dow, right? So, that doesn't mean that the Dow is going to outperform because they're less long Dow right now by a little bit than NASDAQ. That relationship to me doesn't really hold a lot. There will be days that will happen and you'll be like, oh yeah, COT had it. But truthfully, when they're all kind of neutralish on a position basis, I don't see the big divergence there. That's my thought there. I hope that answers. Bobby, can you hear me?
Yeah. Can you hear me?
All right. So, yes, this is my very good friend, Bob. He's a pretty smart dude. Actually, I was just thinking about it. He was actually my first partner in my first or maybe my second CTA, where we got money from Helmet and we went to Goldman. That was actually Commodities Corp, right? That just turned to Goldman and they gave us some money, and it was kind of a semi-exciting time, I guess. And Bobby was the one who actually made sure that there was food on my kid's table while we tried to put that whole fucking thing together. So that's how good friends we are. But having said all that, he's been involved in fixed income for the better part of 30 years, I'd say, Bobby, right?
Something like that.
So my question, and thanks so much, man. Just because we talk about this once a week anyway, but I don't really get it. So maybe you did. So tell me what you think about the whole Fed fixed income story and what it's driving and what the hell, please.
Yeah, I mean, I think the key is, what's the market got right, what's the market got wrong. I think one of the first things is, back in the fourth quarter, in the first quarter, a recession was a near certainty. It was the best forecast recession ever. Everyone saw it as a certainty. And now here, at that time, business investment was declining, residential investment declining, consumption was at a standstill, exports were declining. Now here you fast forward 9 to 12 months, rates are higher, and yet residential investment is expanding, business investment is expanding, consumption is expanding, exports are expanding. So why? How do you answer that question? And that's the first thing. I think a lot of in investing is not so much to get the right answers, get the right questions. And that's a question you really have to figure out in order to do well here. In my personal opinion, what transpired was the goods side of the economy got so large during the pandemic because all the goods money was spent on goods. Much of the service money was spent on goods when you couldn't spend it on services. And then the whole work from home phenomenon took place where people had to essentially build offices in their home, computers, desks, things like that. So the goods economy got exceedingly large. Bottlenecks occurred, and even opportunistic manufacturers popped up to, at any price, if you got a good provided, they would take it. So the goods economy got very large. When the service economy started to open up in 21, the goods economy was still going well. By the second half of 21, the goods economy started to decline. And if you look at the ISM manufacturing index, you'll see it. And for 2 years, it was in decline. And by the time you got to the fourth quarter of last year, ISM manufacturing went below 50. So basically, you began what you would say is a manufacturing recession here in the U.S. and globally. And so that manufacturing recession occurred at the same time the service economy was expanding and opening up. In the U.S., the decline in manufacturing wasn't as large as the service. So overall, the service economy allowed the overall economy to stay out of a recession. But in those economies around the globe where manufacturing was a bigger part of their economy, they got hit harder. Germany, China, obviously to the greater extent. So in those economies, you actually had a manufacturing recession started in the second quarter of 23, and it went deeper than ours. So what's important is what does that recession do to our economy? And where are we? And basically what happens when you have a recession, you free up labor, you falling prices or disinflationary pressures. And largely it was those disinflationary pressures which allowed the economy to run above trend, as well as in a tight labor market, and inflation was falling. And so but the problem is that's pretty much run its course. And to quote Powell in the last press conference, he basically said in his exact words is the pandemic effects are wearing off. So the idea is that and it looked like we're going to head out of a manufacturing recession maybe in the next month or two. And globally, it might come out in the first or second quarter. So the question is when you lose those disinflationary forces, you lose excess labor that comes out from this recession. If all of a sudden you're out of the manufacturing recession with the services not being in recession, that could be problematic for inflation and so forth. So I think that's the first thing. The second thing happened was in October. There was what really sparked this last rally of 100 basis points in tens was there was some discussion about less coupon issuance. There was some discussion about hedge funds like the Ackman covering some shorts, saying it's too dangerous a world to be short fixed income. But it was really the drop off in the ISM manufacturing, 3 to 5 points in the price index and the other goods index. So it was a dramatic drop, and most people saw that as precursors of a recession. The issue is that at the same very same time, you had 5.9% GDP last quarter. Next quarter, S&P earnings are supposed to be up 5%. Everything seems to be inconsistent with that. So what happened? So this is your next question that you really have to have an answer for. How could that ISM index collapse at a time when growth and earnings and everything were strong? And the question, and it appears as though the UAW strike was a more significant contribution than most people give it credit. UAW strike was over 40,000. What people say in the industry that when there's a UAW worker out of work, it idles 4 to 5 workers in the supply chain. So if you've got 40,000 out of work at UAW, you got another 200,000 out of work in the supply chain. The other thing they say is when it goes past 30 days, it affects forward orders. And so you'd had a drop off in orders. So it's our belief that the UAW strike may have contributed to that drop off and may be the main driver for this rally. And if that's true, when this reverses over the next month or two, and if we continue to come out of a manufacturing recession, the outlook for inflation may change somewhat dramatically at a time when the market is looking for a cut in rates. It may be the other, maybe a rise.
So this is the point for me now. This is, as a macro person, which I'm not, but for a macro person, which we all are, whether we want to be or not, I guess. But then that's the biggest in the next 6 to 8 months. That's the biggest trade in the world. If they're discounting in 3 fucking rate hike cuts, okay, by the end of the year. And in fact, what they're going to get is, whatever, 3 rate rises because there's no fucking inflation left or whatever, and everything's going to boom. That's the biggest trade in the world for the next 9 months, if that's right. So, of course, and me, my first thought is, well, there's no fucking way that can work because, the market can't give you a gift like that, although clearly it does sometimes. But wouldn't you say that, Bobby? Like, are you kidding me? If they're going to go from 3 cuts to even 0 cuts over the next year, and actually they got to start thinking about, maybe there's some inflation coming, but God forbid if inflation comes back, it's over. The bonds will be fucking down 100, like, right?
Yeah, really, and this is the other thing that I think feeds this. Many people are victims of recent history. They think it's going to repeat, and it's how they trade the most recent memory. And the reason what's happened in the last 25 years, with the exception of this last recession, core PCE never got above 2.5%. As a result of that, when the Fed's raising rates, if there was any slowdown at all in economic activity, that was enough for the Fed to stop. Because once you turn the ship a little bit and it keeps going in that direction, once they saw any slowdown at all, they would pause fairly quickly and cut within 3 to 6 months. And that's what the market has been conditioned to believe. But largely because core inflation never got above 2.5%, there was obviously some very disinflationary forces acting in the last 25 or 30 years. Mm-hmm. I'm not sure all of them. I have my own feelings, but whatever the reason, those disinflationary forces are not as apparent now. And so the issue is, for that reason, any economic slowdown at all would hurt stocks because it would hurt for future earnings, but it would quickly be followed by a cut in rates. So bonds and stocks were inversely correlated. Right. And that's why they were inversely correlated, because we're in a disinflationary market. Now it's not the same way. Inflation is so high that the Fed doesn't have to stabilize inflation. They need to bring it down. They brought it down some, but the core components of it are still 4 or 5%, double what they really want them to be. For that reason, assets, stocks, and bonds are highly correlated. And that's really what's different. The other piece of it is when you have any kind of a risk event around the globe, call it a war or some potential recessionary action, there will be a flight to bonds. And really, it's not just a flight to bonds, it was a flight to duration. And it was a flight to duration because equities and bonds were inversely correlated. They're not that way anymore. And so as a result of that, what you're seeing is people haven't figured that out yet. And they also haven't figured out that the time.
But you figured it out. I figured it out. Somebody else must have figured it out. We ain't that fucking smart. I mean, we're just 2 guys sitting here watching this shit every day like everyone else.
Yeah, and we could have it wrong as well.
Well, that's what I mean. Like,
it could very well be. It could very well be. And so
it makes total sense to me. The whole, we've gone from a deflationary to not. How can the world, like, what's the next step, right? We went through the deflationary thing because they went globalization, and all of a sudden you were building everything in China and Asia. And, that can't happen again unless you open up. They get Africa together and they move it all there, right? Which doesn't look like it's happening anytime soon. So what could possibly be? That whole story makes sense to me. But what I'm saying is, if that's true, first of all, the time period, as I always say, means nothing. You know what I mean? Like 30 years could be at 5.5, 6 in 6 months. It means nothing for where they're going to be on December 31st, right?
Right.
Because people are still jumping on that train, I guess. But what I'm saying is somewhere in there that becomes a humongous trade if that's right.
Right, and that's why I'm saying it's important not necessarily what the answer is, but it's what are the questions. Getting back to that point, why was this a recession a near certainty in the fourth quarter and the first quarter, and now a year later rates are higher and we're not in a recession? Why? That question you got to get an answer to. I posed a possible reason. I think is Powell seems to believe it. And Neil Kashkari, he calls that scenario I described as a 40% probability as of September. And he thinks if that's the case, rates need to go significantly higher. Now, I'm not sure that's the case, but
Yeah.
so that was one question. The other question is how did you get this fall off in ISM that provided the rally? What caused that? That's the question. So for me, I don't know I pose the answers. The answer might not be right, but the questions you got to get an answer to. And I
I
think
love
those are
the
the
answer of
questions.
that we were talking about the other night, I think. And someone said it on our Discord, I think today. Oh, maybe it was me. But the answer that maybe the monetary policy is not the thing at all. Like it's like a coincident thing that's going on, right? Because the goods economy came down. That's what brought down deflation. That was probably happening one way or the other because all of a sudden the ships started going and the trucks started going and you could get shit again, right? So clearly that's going to be less deflationary. And that makes perfect sense that the reason that was is because of the whole COVID freak out and everything shut down, right? I mean, that's a supply demand thing. Um, so maybe like the monetary policy means jack all. That's my favorite answer for all of it.
That's basically what Kashkari thinks. He's a 40% chance that the monetary policy isn't tight enough. And I think most of the reasons for the cuts next year, if you look at the underlying forecast by the FOMC and street firms, they believe that monetary policy is sufficiently tight. Therefore, the difference between Fed funds and inflation at the end of this year is like 150.
Right.
Well,
Clearly, nobody
at the end
knows
of
if
next year,
monetary policy is sufficiently tight or not, unless we know what the inflation numbers are going to be for next year, which we don't know.
exactly. But my point is, the forecasts they're advocating are to keep the real Fed funds rate the same for the next year or two.
Right.
That's the argument. So my point is, if I'm making the case that maybe, and Powell has said it in the last couple of press conferences, well, we don't know if what the natural rate is. We think it may be higher than we thought. Well,
The
that's what
natural rate of real interest rates.
that's correct. Yeah.
Where
So
are
the
they
natural,
now? Real interest
well,
rate means the Fed funds minus inflation.
yeah, and Fed funds. You argue what inflation is, but you're probably talking about 1.5% real rates overnight. 1%, 1.25.
1.5% real rates. And is that what it's been primarily while they've been doing this, or was it going up, or was it going down?
It was -1 before they
Oh yeah,
started
before
raising
they started
rates.
raising. That's right.
But many people argue that it really matters where the 10-year rate is, not where overnight rates are. And the reason for that is, you buy a car, it's based on 5-year rates. You buy a house, it's based on
Yeah,
10-year rates.
but they're not in
But
control of that shit.
I understand that, but that's what really matters. And that's when they talk about financial conditions tightening, that makes a difference. The reason it makes a difference is overnight rates are sitting at, in the five and a quarter. But you look at a bank like Bank America, last quarter, they have $1 trillion in retail deposits paying 33 basis points. So they're not paying 5% for their money. So even though Fed funds is at 5.25, it doesn't affect their borrow costs. The big banks, it doesn't really affect to a large extent, and it's not where your loan rates are set. So it's not as significant. So
Don't you feel like
in
people are
large part,
yanking their money out of the banks because of that? Like I never really cared. I kept my money in the bank. It didn't matter no interest rates anywhere. Now, every time I get some money, man, I move it out of the bank and into like a Schwab account and at least buy bonds or something like that.
there has been movement, but the big banks still pretty sizable. They still have I think in the
Yeah.
last quarter they went from 1 trillion to 970 billion. I mean, it went down a little bit, but
Yeah. That was
so
my 30 billion, by the way. That was the
that was
difference.
well, that was it. Yeah. So you move the markets. You still move the markets. That's always been the case.
A quick question.
So yeah,
Oh, sorry, go.
No, I was going to say a quick question came in. Based on your guys' experience, have you seen an era that you can compare this to, similar situation, whether it's people trying to predict the recession or how the interest rates are? Can you compare this to a different era that you've been through?
I can't. That's a good question, though.
that's tough. I mean, I'd say in the 70s and 80s, rates, bonds and stocks were highly correlated. For 25 years, they've been inversely correlated. So in that regard, maybe that was a period, maybe 74, 75. But there's a different Fed. People don't really have the confidence on the inflation side, so it's hard to really say. And there may be similar times for certain reasons, but for other reasons they may not be. You know what I mean? So
Yeah,
it's
it's
hard to
always
say.
something new. It's the same and new, right?
And
Well,
that's
I
what
don't
I'm
know.
saying.
The thing that interests me the most is that if that's right, and it scares me that it makes so much sense because then everybody should fucking see it. But if it's right, then that's a humongous that's everything.
The other thing, a
If
lot
we
of
knew
people.
now that 30 years we're going to be at 6.5% in 9, 10 months from now, we would have a huge advantage, obviously, in knowing what to fucking do. Although I don't know if we would on stocks. I really don't know what stocks would do in that situation. You would think
The,
go
the,
down, but
the other thing helping us out of recession are the fiscal stimulus. Fiscal stimulus is massive relative to monetary policy. You look at the CHIPS Act, you look at the Inflation Reduction Act. A lot of these things.
aren't those all done already?
No, they're still going on.
Oh, I don't even
And
know.
we're
No one
we're
sends me
running.
any fucking checks.
Yeah, no. Well, they probably returned to sender. You're running like a 6% current account deficit. I mean, we've never done that at peacetime. So there's massive amount of spending. So,
Right. So the
it's
bearish
that
argument, like I've made, I made it all this all the way to the low of 2 months ago or whatever. Right. I was making that not that I'm making the argument, but you got to watch out for this. That whole thing with the current account and all that stuff. And okay, that means everything blows up because there's no money left. But I don't know,
so
man.
here's another question for you. Why were rates doing fine until August? And from August through October, rates backed up and there wasn't a buyer. Why was that? Why was rates fine for a while? And then all of a sudden for 2 months, they just went
I think
straight
people were
up.
getting whacked out of fucking long bonds, and the long-term trend followers were finally getting out of the long bond trades that they had on since like 1984. Okay, and they went from long to short down there, and that's why we whipped back. And I missed it because the COT data is all fucked up because of those hedge funds. But we see on the trend following guys now, they're still short bonds. That hasn't gone up long enough for them to get long now because they're like long-term bond trend followers. So I think that's why, obviously, because I'm always thinking it's because of the position thing. But why do you think that all of a sudden they went from the interest rates have been going up the whole time? They accelerated into October, but truthfully, if you look at the chart, I mean, for 2 or however many years, 2.5 years, they've been going this way, right? There were some bounces and all that, but I don't know. Why do you think it went accelerated like?
So I think two things. For the right now, the biggest buyers of duration that used to be for the last 5 years aren't buyers of duration anymore.
Right, they're all done.
The Fed's not buyers of duration. Big banks were buyers of duration.
China, Japan,
and
Britain.
Okay, so they're buyers of duration. Now we're having to take on more duration. We need funding because we're running current account deficits 6%.
No, clearly.
We need people. So that basically the supply and demand for money. What happened for most of this year, when the recession was a certainty in the fourth quarter and the first quarter, and it wasn't clear until July that there was no recession. And the issue was,
Yes.
and the reason for all of this year, the money going into bond funds, both retail and it was massive.
Yes,
if
I know.
you turn on the TV, they would question whether you should get into equities yet. I'm not sure, but everyone said unilaterally bonds, buy bonds.
No,
buy
all
bonds.
I have to do is turn on the fucking crowded market report. That's all I said every day for months.
Okay, so from December or fourth quarter, from September through March or April, it was one story, and there was no buyer. The buyers of duration that used to be there for 20 years were buy and hold. They were not mark to market. The buyers of duration starting in September through July or June, those were mark to market buyers. They were retail institutional buyers. And when all of a sudden there was no recession, the only reason the curve inverts is because the sense that a recession is coming. And when Powell in the press conference said that the staff is no longer forecasting recession, that was July, and all the street firms had figured it out as well.
Right, that's when the shit hit the fan.
So then all of a sudden people said, wait a minute, I don't want to be paying 100 basis points through 2s to own 10s because rates aren't going lower.
Stupid.
So people start, so that what happened was people were shedding duration. The bond auction in August failed and had a real bad tail, and 10s backed up 15 basis points that day. Same thing in October, same thing. Bad bond auction, no buyers, thing back. So it was backing up that whole time. And what transpired was that was what was going on. The buyers of duration now are mark to market. They are not buy and hold. You're going to see.
What does that mean?
Well, the Fed used to be buyers of duration. Do they care what the price of the of their position is? The
Probably
big
not.
banks are buying hold. China, do they care what the price of the position is? To Japan, no.
I have no
But
idea.
if you're an institutional investor or you're a retail investor, you care if your bonds are down 10
Not if
points.
you're a retail investor, I don't think.
Nobody cares. I mean,
No, I don't
who
think a
knows?
retail investor cares. They bought the bonds because they're getting their 5% fucking guaranteed. Look, I bought more bonds in the last 12 months than I've ever bought my entire life combined. I put
Okay.
money into like some of that shit, just like, if I'm not going to be fooling around with it in the market, then I'll put it in and earn 5%, return. I don't fucking care. I care if it blows up and they don't freaking make the payments. I care because then I'm going to lose all my principal and be super pissed. But other than that, in a year the thing comes due and then I'll figure out what to do then.
We
But
do have a
anyway,
question
to
that
your-
came.
Go ahead. Sorry.
No, I was going to say a question came in for Bob. What do you, for people expecting a recession next year, like Lacey Hunt or David Rosenberg, what do they get wrong about the economic conditions?
We may have a recession next year. I'm not saying we won't, but I'm saying that it appears from the data that the manufacturing recession in the U.S. will end in the next month or two. And the manufacturing recession globally will probably end in the first half. That's
How
what
does
the
the data say what it's going to say in the next month or two? It said what it did the last month or two.
Okay, ISM, the Purchasing Managers Index was invented about 40 years ago, and they survey purchasing managers in different industries around the globe, and the purpose is to get their view on prices, orders, employment, overall conditions. And the reason they created this index was before this index, they had this index. When a recession hit, by the time companies figured out a recession was there, they had overbuilt their inventories. So not only did they have slower demand, but they had to work off the inventory. So it made the recessions worse. They made recessions worse. So they invented these ISMs 30 or 40 years ago in order to give people the view as to where conditions were going. And so you could quickly put on the brakes, stop orders, slow things down. And that's what prevents recessions to be worse than they have to be. And what I'm saying is the signals we're getting, the ISM data it collapsed, like I said, in October. If you look at it, it's the same kind of collapse that happened in March of 20, which the whole economy shut down. So what happens is people pull back. They pull back on placing orders. They pull back on demand. And the question is, that's in the data. The other part of it is in the data is the continuing claims are up, several 100,000. So those are all signs that suggest we're hitting a slowdown. And all I'm saying is, and that's why Lacey Hunt and these other people are forecasting that sort of thing. Could it be seeing something I'm not seeing? Absolutely. But I would argue, and it looks like some people like Cash Carey and Powell suggested that the slowdown in the recession, manufacturing recession, does two things. One is it drags prices down significantly. Some deflationary, like car prices are down like 10% in some cases. And then the other is disinflationary. But the third piece of it is there's excess workers that are thrown off from that to be used on the other side of the economy. And so what Powell said, and he said a couple of times, it allows them to have above trend growth. All I'm saying is it's one of those situations where in 20 and 21, when you put $5 trillion into the market and it's inflationary, people say, well, at the time you say, well, it's not inflationary. Look at the numbers. It's not inflationary at all. But a year later it was. And it's the same sort of thing I'm talking about here. If the economy's coming back, if we're coming out of a manufacturing recession, we may not, but if we do, then I think inflation is going to be a problem. And the other part, talking about, if you look at household wealth, it's up 40% in 3 years. Home prices are up 40%.
Yeah, I saw that one too. Yeah.
How are you going to have a recession when you've got the unemployment rate tick from 3.9?
I don't know, Bobby. It's insane. You know why? Because it's fucking unpredictable, and you never see it freaking coming. You know what I mean? And that's been my problem. Is everybody sees it coming, therefore I think it probably doesn't come, and therefore I support everything you're saying, and I think it would be the most fucking hilarious thing in the world.
But in a lot of
so much volatility next year that, man, it's going to be freaking nuts, and
a lot of people, in its volatility, a lot of times recessions, probably 20% of the time, it's from some unexpected event that you can't even forecast when that's going to occur. So who knows when it's going to occur? But I would say this.
Clearly, as of now, there's nothing recessionary about anything. Is that true? Some of these numbers are weaker, though, right?
Yeah, the manufacturing side's weak, and because of that, oil is on the softer side. Copper, some of these measures that you typically look at as guiding principles for recession, driven through
What about the whole
manufacturing.
yield curve that's never
But
missed a recession in history, and it's 18 to 24 months after it starts that it happens and all that shit? Is that all bullshit?
but the curve's uninverted. It was
It's
inverted by
still
100 basis,
inverted though, right?
not by a lot. But
Okay.
and here's the piece. And again, who knows? It's hard to say what's going to happen. But in terms of a recession, it's hard to. Well, put it this way: people argue that the stock market has predicted 10 out of the last 6 recessions.
Right.
But what people don't, what you also have to realize is the stock market never missed a recession.
Okay.
Meaning, if the stock market's not pricing a recession now,
right,
then it's unlikely it's going
but
to happen.
we got to know before it starts to.
I understand that, but the market's
Well,
forecast.
what you're saying though is right, because actually everybody thinks recession is coming, yet the stock market's on fucking highs. So
something's
what
wrong.
the hell is that? Right, something's wrong. No,
exactly.
This is why I've been on the macro side the last month or so, or whatever, just totally whacked out because something is wrong, man. You know, I personally believe the market. That's my other point. I believe the markets rather than anything I could come up with. So the stock market would be saying that, but the bond market's not saying that.
Here's the other thing. We're running last quarter GDP was over 5%. Inflation's running 4.5%, 4%. We'll say we're in a 7 to 8% nominal GDP world.
Right,
basically,
ridiculous.
So you're talking about if you owned every stock in the U.S., everyone, you made an 8% return, 9% return last year. Well, how is that going to make a recession? It's just not. You got an unemployment rate running. It's now moving lower. It went down 0.2 this last month, but everyone made 5% more than did last year. Social Security recipients, 70 million, got paid 8% more. You got the striking workers are getting higher wages, so everyone's employed.
There's no shortage of money right now.
There's a trillion. There's a trillion in excess deposits. M2 is running about $1 trillion above trend. Real. So I mean, it's like
I wish that these numbers actually made sense to me though. Like, what's that credit card number that they come up with that people are like have so much credit card debt, which I kind of think is bullshit from what I was looking at today. But there's some number that's credit card debt is the highest ever. Is that $1 trillion? Is that $1 billion? Like, how does that compare to those other numbers you're talking about?
Well, right, but the numbers are the size of the economy is always growing.
Right. No, I get it. Credit card debt is the highest now because the economy is the highest it's ever been. I get that. And as a percentage, it's actually no higher than ever before. But I'm just curious how those numbers match up because I can never put those trillions together.
Yeah. Look, I think a recession.
I don't get a peek into your savings account, so I don't get big numbers like that.
Exactly. It's rounding it. But here's a recession's hard to forecast 1 or 2 quarters out. At this stage, we're not close to that because things are expanding. And when you look at the overall, then there's money everywhere. I mean, think about this rate. Think of the monetary policy. The way it carries itself out is it raises the borrow cost to the lenders, who then raise the borrow cost to the borrowers. And it slows down lending at the margin. Those who buy on credit and those who buy big purchases. Home prices, if you look in the Case-Shiller S&P 500,
they're going up.
It's at all-time highs. It declined from the fourth quarter of 22 through March of 23. That's when it bottomed out, and it turned back up again just when manufacturing did. It followed right along with the manufacturing.
No, housing is the other one. It's silly. Rentals too. My buddy that owns all those rental units in freaking New York City and shit, man. He's like, well, they don't have enough. Like, they all rent. They all rent immediately.
How are you going to have a recession when you have household wealth up 40%? You got everybody employed, almost the 50 within 0.2 of a 50-year low in unemployment. Everybody got paid 5% more last year.
I don't know. They just happen, man, because all of a sudden everybody starts thinking that they're going to happen, and all of a sudden people start losing confidence, and they stop investing, and they stop spending, and they just happen like that. I think. I'm not saying that's going to happen tomorrow. It doesn't look like it's happening tomorrow to me. I mean, the whole fucking thing looks ridiculous here. And my question again is, if that's true, how is the Fed going to cut rates in 3 months from right now? Like, that seems fucking the most ridiculous prospect in the world. Unless something happens between now and March, where all of a sudden shit just drops out of bed, how are they possibly cutting rates? I guess if the stock market would have to go down like whatever, 25, 30% or something, because all of a sudden the numbers got super recessionary, and then maybe they could cut rates, I guess, but they're going to cut rates with the S&P at 5,000. Like, what for? Like, I don't understand.
a question did come in about, on that note, as far as crude oil and the signaling of an economy slowing down. Will that be kind of a tailwind because people have more money to spend boosting the economy? Any thoughts on what the crude oil markets are signaling?
No, I think that's exactly the point. To me, Mr. Freaking Cynic, like which one is it? It's whichever one you want it to be to make your story sound better. To me, is crude oil signaling recession because it's going down and lack of demand for the most used commodity on the planet, I guess? Or does it actually a tailwind, right? Because now people have more money, they don't have to spend it on gasoline, they can do blah, 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 or whatever, right? Which one is it? To me, the answer is neither and both, depending on which one you want it to be, right? Is what I think. But because crude oil could be up it could be up 20% in 2 months too. Like we don't know. It could also be down 20% too. We don't know, right? But anyway, sorry. That's what I think. Bob, you got a thought on crude
Yeah,
oil?
no, and it's kind of like the same story of people say, well, what's the cure for inflation? Well, high inflation cures inflation.
Yeah.
And to the point of the gas price. So high prices makes it hard for people to buy and drives prices down. In the meantime, high prices drive interest rates up because people have to get paid for it, and that drives prices down and demand down. So it's one of those things where it's self-correcting. One of the things with oil, yeah, if it's falling, the question is why is it falling? And if it's falling because we're still in a manufacturing recession. You look in Europe, that manufacturing recession basically bottomed out 3 months ago in June, and it's
Well,
been
then why aren't
recovering.
they starting to buy oil?
And things are picked up. We're still in a recession. It's still contracting. It's still below 50, but it's contracting less. And if you look at this, and I think that's also those leading indicators for the ISM in a contracting mode, and that's where the fall off I think may have affected people's orders, but it seems like it's reversing. There's a
I'm just looking
10%.
at like the oil chart. Oil's basically where it was in 2006. Okay, it ripped into the 2008 freak show and then went straight down into the 2008 crash. Then it basically just traded around these levels for 10 years. It went down in COVID, then it went freak show up after COVID, and now it's back to those levels where it was trading basically for 70% of the time between 2007 and now. So this is always what makes me cynical about the moves of like, hey, what's it mean this month or this week? Because if you really look at these long-term charts, it doesn't mean shit. Oil's going to go up or down. The economy's going to go up or down. I don't think personally it means shit. But again, that's just me. Sorry, go ahead, Bobby.
No, it's fine. I mean, I think the important thing is to get the bigger trends as to what's going on, and then you can find out, what's changed. What's changed. And I think, the fact that oil is low, where it is probably a reflection of the, being in a manufacturing recession globally. And I think until we get out of that, I would suspect that it's still going to be where it is. But if we're out of the manufacturing recession in the next month or two, and Europe's out in the first half, what's employment picture going to look like? What are wages going to look like? What's inflation going to look like?
On that note,
So
Bob,
where you were benefiting. Good.
No, I was going to say another question came in. If inflation is coming back next year, which point of the curve do you think is best to short on a risk-adjusted basis?
Well, if you look basically what happens when you get a big change in sentiment, which happened, as I mentioned, with the ISM figures, it takes 4 to 6 weeks to price that in. And the way it works is this.
Well, we're there.
That's exactly right. The implied forward curve and the median street forecast will become the same. When you get a big change, they drift apart. So back on the 14th of November, the 10-year rates, the street forecast and the implied forwards are 100 basis points apart. And in between the 14th of November and the 20th, 2 weeks later, they had drifted to be 50 basis points apart. And here we are 2 weeks after that, you'll see you're only 15 or 20 basis points apart at the long end of the curve, and the front part of the curve actually inverted. You actually have the street forecast is higher than the implied forward. So to answer your question, what happened in that case was the front part moved first and the back part has been moving second. And that's where the gap closes. So you could argue if it goes back the other way, it's probably going to steepen pretty quickly. And I think when duration gets hit hard, and you also can look at spread product.
Hold on, it's going to steepen quickly if the inflation story comes back.
If it comes back, yeah. So I would say, the longer end's going to get killed if it happens.
Because this is another one that makes me nervous, because that is what I have believed so strongly. And it really, except for a short period of time in the fall, hasn't really been the case to me. Like, Jason, what's your number one macro trade for any point next year? My answer would be you got to sell the shit out of the long end, right? The curve's going to steepen, but I think everybody sees that, man, and it's not. That's my whole problem. It's like it isn't steepening. It's still inverted. The short end to the 30s, the twos to the 30s, or whatever, right? Because I feel like if they know that the Fed is not going to cut rates, then the long end will be fine. The problem is if the Fed cut rates, I would expect, right, that the long end would get freaking destroyed, right? Because now they have to start pricing in growth and inflation, and they're already coming from a point where there is growth and inflation. So I feel like if they cut rates in freaking March, if we're where we are in March economically, the same bullshit randomness, everybody going out to dinner every night and paying freaking $1 million for a $900,000 home, and if we're still there in March, and they cut rates, then I got to think the 30-year is going to go down freaking 50 points before anybody even fucking knew what happened. Which makes me feel like that's not going to happen. Okay, that's my point, right? So maybe they really know that they're not going to cut rates. So I think the answer to that question in my case would be the short end, because mathematically the short end is the one. If they're going to go between, it's not a lot of money though, I bet, but if they're going to go from their cutting rates 3 times next year, the December Fed funds contracts, or however the hell they do that, and you believe that they're not going to cut rates at all next year, then you sell that December Fed funds. Is that correct? That's the right trade, right? And you'll make whatever that is, 3 interest rates that they're discounting in now. So you'll make 25, 25, and 25 on that. Is that the right math, Bob?
Yeah, I mean, I think it's about direction. Like I said, the gap between the implied forward and the median forecast in early October that developed because of what I said, that ISM and some of the other data got very bullish. It was 100 basis points. It came out of the front end first, and then it came out of the back end
Later.
To a lesser degree, and it's come later. And generally speaking, the things
I
reverse
still
the other
personally
way.
think that's trend followers just getting fucked here. They're still short, man. They're still super short bonds. They started to buy. It looked like one of the guys posted something this afternoon or this morning about the trend following ETFs. They're starting to buy them back, but they're still short up the freaking ass across the whole fixed income curve, especially the long end. So I think they're all getting squeezed there.
Yeah, and to a large extent, the long end of the market prices in the price of money. I mean, they supply and demand sets prices, and I don't know that the Fed really has a lot to say about it. Whatever they
don't have
to make
anything to say about the long end.
Well, if they make it worse,
they buy it all.
if there are inflation problems, they don't deal with them. The long end will get beat up. So it almost runs in reverses sometimes.
Yeah, no, you're right. It could go either way. Look,
Okay.
I think the fundamental answer to that question is you do the short end, but probably the momentum answer is you do the long end. Like, it doesn't really make sense that the long end has ripped the way that it has in the last month, even if the short end did, but it's still dead because people will just chase. You know what I mean? Chase duration. Why are you going to trade the Fed funds and make basis points when you could chase the 30 years and make 3 points in 2 days?
There's a good chance the Fed doesn't do anything for at least 6 months. And there's a bunch of reasons why. And when all's said and done, in terms of tightening of financial conditions, 100 basis points higher in the 10-year is probably equivalent to 500 basis points higher in Fed funds. So what happened when the market was backing up and getting pounded, the front end was pegged. It was the back end getting killed. And so what happens is, in large part, the Fed's not likely to do anything. And they're not likely to do anything for this reason. Powell argued when inflation was a problem, he argued that inflation disproportionately hurts the lowest income and minorities. And for that reason, we have to get it fixed. But the hawks on the committee would say, wait a minute, but you're raising the unemployment rate by 1% will disproportionately hurt the lowest income. For that reason, they will pursue a strategy which solves both problems as long as there's a possibility of it, even though it's not the most likely outcome. Meaning,
Okay.
even if it's a 20% chance that they can not raise rates, not raise the unemployment rate, and get inflation under control, they're going to pursue that policy path.
I hear you. You know what? I just want to.
For that
I want to
reason,
fast forward to March because I want to know
but-
like what
but
I
that
want
means
them to cut rates in March because I can't fucking see it at all. I want them to do something that it just to me I can't I just can't see it at all. Could I see that we go into a recession next year and they cut rates later in the year? I could see that. But
which gets the other piece. They may, because
March is
it's an
3 months away.
election year, they may want to cut rates. They may
Oh,
want to
please.
keep the
There's
market.
no fucking way. I'll
But what I'm
shoot all those bastards if they do
but
that.
but they can't control the back end. If inflation's a problem and growth is a problem,
I don't
tends
believe
to
the Fed is
kill.
involved in is involved in the election. I mean, I'm not going to say it
No,
like that,
no,
but there's no,
no.
if they're making decisions based on elections, man, then we're all fucked anyway.
Well, no. What I'm saying is, it's hard to see. There are people you don't know if they're going to, or they are, whether they're going to raise or not raise. Doesn't matter. My point is, it doesn't make much difference if 50 basis points in Fed funds is equivalent to 10 basis points. So if it's 10 basis points in the 10-year, or 100 basis points worth 500, so it's like 10 basis points in the 10 years equivalent to 50 basis points in Fed funds. So what I'm saying is, it's unlikely whether they move 25 up or down or 50 up, it doesn't matter relative, because the 10-year is moving in large scale such that it overshadows whatever happens on Fed funds. It's a rounding error. So it's not even worth talking about whether they're going to cut rates or not. What does matter is if inflation's a problem or growth's a problem, the long end's going to move. 10s are going to move. And that the Fed can't stop it from moving. We're not like Japan. They don't have yield curve control. So it's going to move.
Yeah,
So
but then
the
if you get
answer
into
is,
the political part of it, the whole political conspiracy theory of it, you can get into like they can't afford that, right? People get into that argument. They can't afford interest long rates to go up like that because which clearly doesn't make sense to me. It makes me believe that everything's going to crash. Who gives a shit what they can afford? That the world doesn't give a shit, right?
what I'm saying.
Give a shit,
Yeah,
but they can't afford it, so they'll support it, so they'll print again. Look, this gets me to the whole bearish argument. I don't want to go there, but
and we do have our next question. Just a quick disclaimer: Jason is a pacifist and will not shoot anybody. For the record, just to go on mic there. All right. Next question. It feels like in the last year, everyone was talking about how Europe and Germany specifically was in the middle of a recession, yet the DAX is heading to new highs. Isn't everyone prepared for a recession, just like they were in Europe? Isn't that a similar story?
I think so.
Stocks price in what's happening 6 months to a year out. And what I'm saying is, by that time, Europe's out of recession. That's what it's pricing in. Look at either the European PMI, the Purchasing Managers Index, or ISM, or the UK. Based on the trajectory, they're still in contraction. They started in June. They bottomed out. They bottomed out this past June, so they're in for declining for a year. They've been improving since, and the stock market is pricing where things are a year from now.
So what you want is just long stocks, short bonds. That's the pairs trade right there, I think.
Say it again, Jason.
I think you want to be long stocks, shorts, bond. Look, I don't trade like this, but if that was my discretionary call, if that's the case, if we're going to have growth, you probably want to be long stocks, short bonds.
Got it.
Which seems impossible, but
But the other thing you realize is there's a high likelihood that stocks and bonds will be correlated as long as real rates are the issue, and it's likely.
No, but what about if they don't cut and because the growth is too high and these companies are making? I'm not saying people aren't ready for that in the stock market, man. They're not ready for that. People in the stock market are not ready for earnings to beat next year and us not be in some sort of slowdown at the very least. I don't believe people are ready for that. The stock market clearly is going up. So people will tell me I'm crazy saying that the stock market's not discounting that in. But to me, the behavioral part, people are not. No one's talking. Tom Lee maybe is saying that because he says that every day. But other than that, people are not saying that in the stock market. The stock market itself is saying it, but the people that are involved in the stock is not saying that we're about to have growth and there's going to be no slowdown next year. I feel like do stocks have to go down on that, even if rates went up? Do stocks have to go down on that? I feel like they don't. They could, clearly, but I feel like they don't. There will be days when they will. Bonds will go down. Stocks will go down because of it. But shit, man, just Friday's bonds went down and stocks went up. So, I'm talking about you look at – I don't know.
I'm talking about over a period of time. The issue is the equity markets have told us, or they're signaling that the earnings recession may be over, and that next year they're talking about maybe what's forecast, whether that's true or not, forecast 5% revenue increase and 12% earnings increase. So that's, and the other thing I would tell you is non-financial corporate profits. In 2019, they ran 9%. In the depth of recession, in the pandemic, they got up to 17.5%, and we're now at 14.
Wait,
So
what was 17.5%?
Non-financial corporate profit margins. So
Oh.
other than banks, the corporate profit margins were 9%.
Okay, so what does that tell me? I don't even understand what that tells me. So they're
It was
making a
9%.
shitload of money like they always do.
But they were making 9% in 2019, the corporate profit margin.
All right,
It
now
got
we're
to
doing better.
17, got to 17. 17 hadn't been that high since 1952.
That was what, after
And
the pandemic that it got to 17?
yeah, because the people are making, prices were going higher.
Right,
you know,
right.
And now you had a situation where it's declined to 14. In the last quarter, it increased. It was like 14.3. It's now 14.8. So
Okay.
basically, your non-financial corporate profit margins are 50% higher than where they were in 2019.
Okay.
We're in a 9% or 8%
That's
nominal
got to be in the
GDP world.
market. Maybe that's why the market's going up. So
Yeah, and that's what I'm saying. So the idea, that's what's backing the market. But when people talk about the Fed and where interest rates, what they control doesn't really matter too much. Because
where do you come up with these numbers anyway, Bobby? I think you're just making them up.
Well, I can send you the chart. I'll make up numbers.
How do you have so many of these numbers though in your head?
Well,
You
you
got
can
them all.
look them up yourself. I can send you. You
No,
can look
I'm
them up.
only
I
kidding.
don't
I
care.
trust everything you say, as you very well know.
And we have a two-part question for Bob, if I may. Can you talk about what we learned from the drawdown in the reverse repo facility? And the second part is, do you think the Fed can control the long end of the curve?
Let me answer the second one first. It can't. I mean, when rates went up, it backed up from August through October by 100 basis points. How did they control them then? And then they went from down 100 basis points from October till now. Did they move down? But what did the Fed do to control them? I don't think they have anything to. I mean, their policies can affect it, but it's really driven based on the market, and that's really the difficulty. Is look, the economy follows the market. What I mean by that is stock prices will move first, and then earnings decline. I mean, the stock prices price them in. Same is true with bonds. They price it in and it follows. So what happened was the economy went from August, which is inflation's going up, everything's improving, then the first quarter was a recession. Then all of a sudden it went to growth, and for 3 months things were backing up. And the market is, bonds in particular, trying to forecast. They want to get in front of it. They want to go to where it is. And then all of a sudden we had a situation where the ISM collapsed, and people said, "Holy shit, I need to be with the cutting rate, so I got to go, on the rally side." And they went long duration. So the market is trying to quickly anticipate this change in direction. And so the answer to the question is, I don't think the Fed really has much to say or has any control over 10-year rates. I mean, their policy can affect it, but
other than QE though, other than QE.
Yeah, QE and QT. I mean, that does have an impact on supply.
What I'm saying is, if they really want to, then they can. They don't naturally, but if they want to make it unnatural, then they can do that shit again.
That's true.
Sorry, I didn't mean to interrupt, even though I always do. What was the other part of the question? Did I miss that?
The other part was related to the reverse repo. Can you talk about what we can learn from the drawdown in the reverse repo facility?
I'm not sure. I don't know the implications of that, insofar as I'm not sure what we've learned. I would say, yeah, I mean, you're talking about where things are getting a little squirrely now. Yeah,
I don't even know what reverse repo is.
It's the
When
Fed.
they take
It's
your
the
car.
Fed.
Oh.
Yeah.
No,
Exactly.
that kind of repo I know. I know too well.
I don't have an answer on that. I don't think it's
No
clear.
worries.
There's a lot of acting on that.
And Lindenbrook, if you want to clarify that question, please post it in the chat. The next question is, why do you think the Fed is obsessed with that 2% target inflation? Is there a data point behind it where if they hit that 2% target, it's good for the economy? What are your thoughts on the 2% inflation target?
I think they picked one 30 or 40 years ago. They want it low, but they don't want it at zero, because if you get inflation, you can raise rates to slow it down. But when you get in a deflationary environment, it's pretty psychological. It's hard to fix. So they wanted the lowest they thought was reasonable without going close to zero.
No, and the systematic devaluation of their debt that they have to do year after year by some sort of inflation, right? That's all inflation does, right? They have to do that, but they can't. They're just my opinion. They can't let it get too high, because then people freak out about everything, right? So it can't be zero, even though it should be.
You can't get zero, because if it goes negative, it's hard to fix it. So the question is, they want it close to zero without being at zero. And I think 2 might have been more arbitrary. I mean,
inflation is so much of everything, including the growth over time. Such a part of it is actually just inflation, right? They have to have that at the very least, something 2-3% inflation. I guess it's 2, but that's just me thinking. But
and the idea is, some people think it should be 3 at this point, because it's
they have no
harder to get
choice.
Hard to get it to 2. But the point of the matter is, if they start changing it when it's a problem, then there's no confidence that it'll ever be something that's held to. So they feel as though if they changed it 5 years ago, great, 3% they could do it. But when you're in the middle of the problem and you're trying to fix it, well, then people lose confidence. Here's the key on inflation: people, where's it coming from, and all that stuff. Companies set prices of goods. They set wages. They hire and they fire. They have all the levers. When it's close to zero and there's not much ability to raise prices, you'll find they try raising prices and then they lose business to somebody else, and they stop. They get hit so many times they just don't do it. Once things start open, it was kind of the Wild West in the last year or two. They could raise prices 8 or 10% and not a problem. They didn't affect their volume. And so while they can control, as long as companies have pricing power, they're going to move the levers to their advantage. And when it first happens, inflation's was up 8, wages were up 5. They lowered real wages by 3%. That's huge. I mean, in a normal recession, you lay off 2 or 3% and you save 2-3% on your wages. Every company in the U.S. saves 3% on their wages on average. So that's a problem. So the issue is, as long as you have pricing power, it's going to be a problem. And I think the 2% thing is more arbitrary. I mean, it was something they studied and fixed, but they wanted not to be too close to zero, but they didn't want it to be a larger number because it could be problematic.
Gotcha. All right. Next question. Ed Yardini believes we are importing deflation from China. Any thoughts on this?
I would say for 30 years, China moved 400 or 500 million farmers living in the country who were farming by hand. They moved them into the cities. They built factories, and so they turned online tremendous amount of capacity of manufacturing and labor. That doesn't count India, Thailand, Malaysia. So you had this huge influx, which I think are fairly disinflationary forces for 30 years. And that's gone on. And for 30 years, they've been exporting disinflation. So to answer your question, it had been going on for 30 years. Now the question is it happening still? I would argue that there's been a push to move manufacturing away from China. And last quarter, we had a 0.4% contribution to GDP from manufacturing construction, which is the largest contribution in 40 years. So for manufacturing to be reinvesting here, so part of this 6% of our current account deficit being stimulus, it's going to manufacturing, building factories all over the place. So that's one thing. So I would say that manufacturing capacity is expanding because we're building it in other sources other than China. So there's a good chance the market will have too much capacity in a couple of years. So in that regard, we did have disinflationary forces because they had a social policy that went on for 30 years, and that has come to an end. But now they may just be because everyone's moving away from China. So to answer your question, it could be a problem. It could be a disinflationary forces from China.
Staying on the China theme and adding Japan, what's your take on China and Japan exiting treasuries?
China is doing it. They're trying to, my personal opinion, trying to move their reserves out of dollars. They're, what you might say, sanction-proofing their money, and they're trying to trade in currencies other than dollars. And so they're making I think, a strategic push, and have been for a year or so, and they'll probably continue to do that to move away from the dollars. Japan is in a situation where they're starting to move so in that regard, China has been the last couple of months. I think they're the largest. They've done more selling of treasuries than they've ever done. Is what I've
They're
read. So I
net
haven't
sellers of
analyzed that,
treasuries,
but
China.
yeah, that's what I've read. So I haven't looked that up, but that's what I've heard. And in terms of Japan, you had a situation where rates were negative or zero or low for so many years with the yield curve control, and now they're moving higher to make them attractive again. And so you have a situation
Yeah,
where
I hate
things
that argument.
well, I mean, I don't know if it's true or not, but
I'm
that's
just
what I've
saying,
read.
10 years in the US, you're at least still getting, or even Fed funds in the US, you're getting 5%. What are you getting? So you went from 0 to 0.01 in Japan now? Like, that's really
Well,
going to get you to freaking make a decision?
well, they're expecting it might be 1.25, 1.5
Well,
by the
then
end of
wait
next
until
year.
that happens, and then they can do it.
Yeah, I don't know the answer. That's what I've been
Okay.
told. That's what I've read. So I don't know. I don't have firsthand knowledge of that.
Bobby knows so much about China, by the way, because me and him and his wife and his 4 children and my 3 children got on a fucking plane. These lunatics got on a plane with me. I planned the whole thing. And we went to China for a month. We ran around China for a month, and we ended the last week in Beijing for the Olympics. That was in 2008. And yeah, these poor bastards had to spend a month with me on the road in China. It was crazy.
It was something.
And we're still friends despite it.
Crazy thought.
All right, so we want to go into anything else that is
Yeah,
there's for my head.
There's 2 more questions. Great discussion so far, Bob. Really, really appreciative of you being on here. A lot of positive feedback. What's your view on gold, especially with this move last week, and it's been a short trade this past week based on positioning. But what's your view on gold and with the potential inflation and everything else that's going on?
I mean, it's a non-earning asset. I mean, it's a challenge. I mean, put it this way: if we're in a 7 or 8% nominal GDP market, you know, gold's got to go up 7% just to break even on the trade. I think it's a flight to quality issue. I think it's the Chinese and those, they're trying to move into commodities, and they're probably, gold's probably one of them. So I would think that the other issue you've got is a concern about, at some point, will inflation be a problem? U.S. government just borrowing and spending, and at some point that's a problem. At some point, you probably want to own gold, but the timing, I don't know if now's the time. I just don't have a strong feeling on it.
Again, the other side of the whole thing is what's going to happen with interest rates too. If interest rates are about to go from here to deciding over the next 9-10 months that interest rates, in fact, go from where they are now to where you would think they would have to be if they're saying, oh, the Fed didn't cut rates the entire year. In fact, they raised one time, right? Then that's much higher interest rates, and that clearly is going to affect, I would think, at least the psychology of the price of gold as well. So there's 2 sides of the coin to that one, right? Oh, the coin, get it? So maybe that's why gold is, again, maybe that's what it's trying to say here, but I don't believe it. I just believe they got too long. But you could make the argument that gold could go down if rates are going up from here till next year end too, right? Even though inflationary, the rates are going to go up because it's inflationary, but then rates go up. So that's disinflate, and this is what I hate about all this shit. But sorry, I had to throw my 2 cents in there.
Well,
So you don't love gold, Bobby, but you think it could be either way.
It could be longer term. I don't see an immediate movement, but it could be something. I don't see it.
I have a question for you too, Bob, and then I know there's one more, and then I'll be done. I get all this stuff, and it's all super interesting, but what are SPOOs going to do this week?
I don't know.
Okay.
You got Powell. The question is, when the market is super hawkish, Powell and the Fed gets kind of dovish. When the market's super dovish, they get pretty hawkish. So my guess is that what they're going to try to do for the next 2 years, since they're not going to move much on rates, and whatever they're going to move is insignificant. Whether they go up a couple times or down a couple times, it's really the 10-year that matters. And so I don't think, personally, their biggest concern is to manage inflation expectations, and that's all they're focused on. And in the last press conference, so the answer to your question is they could become a little bit more hawkish, and that could hurt
which
stocks.
I don't know if that's good or bad for S&P, quite frankly. I could argue it's good, but
Yeah.
Bob, Jason did say you're the best day trader he knows. That's why he asked that question.
Ha!
The king of the day trading, Bobby
Uh,
Fang. I can't say
just
his last.
taking it back to COD and the report, more for a question for Jason. What would it take for you to take an outright position either in the NASDAQ or gold? Or is the thought process to continue to do a pairs trade and hedge for the end of the year just because there's so much kind of the correlation went away
No, I would take a short fucking in gold right now. Especially because I have long Canada. I would be very surprised if at some point this week I don't get short gold. I want to go back and see like if we could consider one of those days news failures last week, then that could be traded against that high, but it's kind of far away now. That's my problem is where am I getting out as wrong? But somewhere I wouldn't be surprised. If Canada starts to act like shit, something like that, and gold's going down with it, I wouldn't be surprised. So I got no problem being short gold right now. And I love the idea of the correlation can break for some reason as well, and it could be a two-sided trade. I've seen that happen before, so I think that's a big opportunity here. I really do. So I have no problem with that, COT wise or any otherwise. Was there something besides the gold
Yeah,
trade?
for the NASDAQ, what would it take for you to get short
And I think it's
outright
going to take me a lot more. I don't.
on CPI day?
You know something? The index gave a sell in Dow this year. I didn't take it. Okay. I even think I did a video about it, and I think I was on like someone's thing on Twitter one day saying there's no way I would short stocks at all the rest of this year. And 3 days later, the COT came out, showed the index was long Dow, and we had a news failure. And I did a whole video about, I'm getting short here. I think it's a short here. And that was in August, and I didn't take it. Okay, and the market went down from August all the way, obviously, until November. It was pretty whippy. By the time you got to mid-September, it was basically where I would have gotten short. It went lower, it came higher, and then obviously in September and October, it ended up going lower. But I didn't take that trade. This might be a similar example here. I have a hard time with the index right now, knowing where it came from, and knowing that I still think that perma bears are still perma bearish. I still think people are too caught up on the recession trade. I'm gonna have a hard time. Now, look, if CPI comes out lower or some shit like that, and we get some big rip, and some dick face comes out on that day and says, "Oh, I'm completely wrong, and the market's going up from here to your end," and we close down, then I may take a stab at that point, on a news failure CPI reversal day type of thing. That might be worth a trade, but as always, getting short stocks is the hardest trade for me for so many reasons that I've talked about before. The main reason being I have to guess it's where I have lost the most money in my entire freaking life. So, and clearly my entire trading life, other than a few years, the stock market has done nothing but go, up a lot. Obviously not in 08 and all that, but over time. So it takes a lot for me to get short stocks. I would rather have the trade on somewhere else than short stocks. And I feel like maybe short, one of these other things, short bond, short gold, maybe Swiss, or maybe Canada. Maybe that would work in that situation. But so that's a long-winded answer to I hate being short. It takes a special situation for me to get short. I don't know if this is it. It doesn't feel to me like this is it because this has been a big theme the last few weeks. Getting in, we had a long discussion on this the other day. I remember getting in is one thing, but where am I getting out of the trade? I can get in on the NASDAQ failure and it could go down for a week or two, and that's great. But I got to sit on it all the way until the shit goes neutral. You know what I mean? And where am I getting out? I got a hard time believing. I don't know how I'm believing the stock market can go down for a few weeks, but I got a hard time believing we're seeing highs here. Now, I think I probably said the same thing right on the lows at the end of October. I got a hard time believing we're seeing lows here. So take that for what it's worth. But we're basically on fucking all-time high in the stock market, and we're close. And there's no way that anybody can tell me that the massive psychology of it all here is as bullish as it was the last time we were at highs. There's no, you have a hard time convincing me of that, right? From still the same people that I talk to, still the same wealth managers that I talk to that tell me that their clients are the most in cash they've ever been and they ain't budging. And it's fine if they don't budge. Bonds are going up too. They're making a little bit of money in bonds, but as it turns out, even though they might be making a little bit of money in bonds, their opportunity cost has just been ridiculously bad not being in stock. So, and all those people have not budged, and I just don't see it. And many people know that over the last few years, I have made plenty of massively bearish arguments, some right, some wrong. I've made arguments that I didn't think the stock market was going to go anywhere for 10 years. And it still may not. But right now, looking at the chart, listening to what people are saying, and looking at the COT and realizing the weaknesses in the index thing, it's going to take a lot for me to get short stocks. Sorry to be so long-winded about that.
Appreciate the response, Jason. Bob, any thoughts on shorting equities at this level?
I think you look at a graph for the last 6 months of real 10-year rates and the stock market, or just 10-year rates in the stock market, and I think there's a super tight correlation. And I think, I think that's a big driver. Look, equities are a long duration asset. They're a 33, 35-year duration asset. And so, and like I said, for the last 25 years, bonds and stocks were inversely correlated. Now they're more highly correlated, and they're long duration. And if you look at the movement in 10-year rates in August, September, October, during the time when rates were moving higher and stocks were moving lower, and then in November and December when rates are moving lower and stocks are moving higher, it's a big part of that puzzle. And I think that if you go forward, I think that's going to be the driver in the short run, because right now bad news is good news, and equities aren't going to really find a bottom until bad news is bad news. And I think we're a long way from
Find a bottom. What about when they're going to find a top?
Well, right now there's
bottom.
Well, that's my point. How can you tell me there's going to be a recession next year when stocks are at all-time high, home prices are all-time high, household wealth up 40%?
Stocks are at all-time high in fucking September 2007.
Yeah, there you go. So look,
they're always at an all-time high until a recession comes. You know what I mean? Like,
yeah.
2007. Jeez, these charts go back.
So I think for now, I think rates are a big component of the movement in stocks. I think it's a huge driver. And I think, and I'd say that right now rates are moving lower, and that's what's driving stocks higher.
For sure.
And if we're right about coming out of a manufacturing recession, and we're coming out, and if we're right that the UAW was a big piece of what showed up in some of the data, and that's reversing, if in 3 or 4 months things are improving and going strong, I think rates in the long part of the curve will respond to that. And
then stocks pressure with it, probably, yeah.
That could.
I could see this all going up all the way till March. That would be super fun. All the way till the March meeting. Everything go up all the way till the March meeting.
Oh, when they're ready to cut.
Why not? That would be awesome.
Yeah, there you have it.
I literally can smell that, man. The stock market just doesn't feel to me like it's going down. So I could see it go up all the way until the March meeting. And if that were the case, then like what you're saying, the bonds are probably going up all the way until the March meeting too. All of this can be right. All of these things about no recession, inflation coming back can be right. And it doesn't mean that 10 years can't be at 3.5 in March. If it's right, then it means 10 years will be at 5.5, 6.5 by December. But none of this, I don't think anything means anything between what happens between now and March. Don't you think?
I agree.
Yeah, so that's the dangerous part for me. I'd love to put this trade on just to fucking put it on, be short bonds somehow against something, but I'm not going to do that until, because I've learned that sometimes you get that totally right, but it doesn't mean anything for even the next 3. Even if you get a 1-year call right, it means nothing for the next 3 months. Nothing.
The other thing is, I remember talking to a head of our treasury desk back in the taper tantrum, and the yields were backing up, gapping up, and I'm like, when are yields going to start backing up? And everyone who's buying, corporates and mortgages and all that, they're saying, when are rates going to stop backing up? When are they going to stop backing up? And he turned and said, "Oh, you tell me when people are going to start buying mortgages and corporates, and I'll tell you when rates stop backing up." And so what that means is, when the backup was happening in August and September, spreads were widening on product, and so you see there's a lack of support on the duration. But once the duration stabilizes and a spread product tightens, like last month, the mortgage spreads tightened the most they have in history. It was,
well, yeah, because that's what everything did.
So that's my point. So my point is, as long as spread product is holding in well, you're not going to see a backup of any size. It's when when you get some kind of failure of an auction or something else, and bonds start to back up, at some point they back up fast enough, spread product starts to pause. But we are not there yet. You would wait for that kind of a signal probably to want to get short duration, and it would probably be more the activity at the long end, because nobody's going to think the front end's going to move.
March. I hope
March, yeah.
everything goes up to March. They cut in March, and then that ends up being the top of everything. If that could just freaking happen, I feel like I can make some pretty good money off of that idea. Because if they're gonna go up all the way until March, people are gonna have to be getting long shit, man. And by then, I will be able to really get short something, and then we'll have a great piece of news. The Fed cut rates, and then we'll see. It'll be game on. God, I hope I live that. I hope I make it till March. And I hope that actually happens, although it doesn't sound like the rate cut part is going to happen. I just can't, again, I can't see it. But hey, maybe the fact that I can't see it and we can't see it, maybe it happens. That would be freaking great.
It may happen. I'm not saying,
That would
you
be
know,
great. I would love
I'm
that.
talking more about the long end of the curve. The Fed could do anything they want. I mean, if inflation's coming down, they may cut rates. I mean, they're
That
wanting
would be
to keep.
awesome. That would be
They're wanting
such
to
a
keep.
good news failure on 30-year bonds if they freaking cut rates in March and 30 years went up 2 points and closed down that day, which is exactly what I think they should do. And that actually happened and they were long. That would be freaking awesome. I get one of these about once a year, so maybe it'll be in March. That's pretty early in the year. All right, well, I'm gonna I don't know. I'm gonna let you go, Bobby, first of all, because I appreciate you spending over an hour with me, man. And these guys. I think they all probably pretty appreciate it too, because most of my answers with this stuff is I have no fucking idea. I can pretend like I have an idea, but I don't have much of an idea. So I appreciate it, Bobby. As always, man. You're the best.
No problem. Try to help any way I can. Hey, take care, guys.
Thank you, Bob. And
See you guys.
see ya. That brings
Thanks,
us to the end of the session. That's an hour and 20 minutes of a great discussion between Jason, Bob, and great questions in the chat. Probably one of the best Q&As we've had. So thank you, everybody, for joining. And I'll post this in Discord by the end of today. Everybody have a profitable week. Thank you.